Hi, everybody, and thanks for listening to this presentation. So I plan to discuss a recent thematic that we published on within the semiconductor industry, which was titled Compressing Valuations and Mounting Risks, Now What? So this video clip is really only intended to provide some high-level insights on our current views of both valuations and risks within the space. If you're actually looking for a more full in-depth outlook on the subject matter, definitely check out the published thematic research on MarketScope Advisor. So here's our disclaimer. Just take a quick read before we move forward. All right, so on slide 3 here, in this table, we just compare the most recent decline to prior semiconductor corrections, 9 total in the last 15 years. And I would note that current levels or recent levels essentially are in line where prior downturns have found the bottom. Of course, that assumes that the current correction isn't the start of a recession, which has seen much larger declines. The decline from the December highs that we saw to the recent March lows has essentially equated to about 24% for a CFRA semiconductor industry. In any case, though, history says that pullbacks like this have been a great time to buy stocks with positive returns, essentially in every case a year later. Now, while we're of course mindful of some of the mounting risks amid the Russia attacks in Ukraine, among other things, we'd also highlight that semiconductor stocks often discount a lot of these issues well in advance of potentially expected consensus estimate cuts. And stocks have also been known to really climb a wall of worry after witnessing cuts. So that said, let's move to slide 4. Now, depending on the type of investor you are, you may find this chart to be extremely bullish or a bit scary. But essentially, this chart is intended to take a look at how chip stocks have performed long term. Semiconductor stocks have arguably been among the best areas to be exposed to outside of the cloud within the IT sector and the broader stock market post the financial crisis back in the 2007-2009 period, as well as since the pandemic lows back in March of 2020. Nonetheless, given the risks here in the intermediate term, we're hard pressed to really anticipate significant multiple expansion, and it could be challenging for certain chip stocks to return to their prior highs. But that all said, we do believe the industry remains on pace to grow at this kind of long-term compounded annual growth pace of about 6 to 7%, at least through 2030 is more our long-term outlook, with content growth from data centers and autos really leading the charge. So the semi story, in our view, is really far from nearing the end here. Now, on slide 5, just semiconductor valuations here have compressed over the last 15 months. It hasn't really been a 3-month thing, but it could still have downside compared to other fear moments in the last 5 years, right? So the demand environment still remains very robust for chips of all sorts. We believe the actual compression in multiples since the start of 21 makes sense as the cycle continues to get longer in the tooth. Now, we're in the 9th quarter, actually about to essentially into the 10th quarter of a semiconductor cycle that historically lasts 8 to 11 quarters, and ultimately tougher comps and decelerating growth in end markets will lead to a period of softness. The question is, when does that happen and for how long? Essentially, the industry trying to, at some point, manage a soft landing. Now, you can see from this chart that semiconductor valuations got to the lower half of its trading band seen in the past several years. Clearly, if concerns about Ukraine-Russia were to intensify, could set up a greater fear environment for chips during the pandemic back in March 2020, or some of the tariff issues back in December 2018 bottoms. In both those cases, though, multiples on average got to about 12 times to 14 times, with value names really taking a bigger hit than growth names. This recent pullback actually was different, with growth underperforming value, though, which could partly be due to some of the anticipated moves by the Fed being thrown into the mix. And then separately, if those Ukraine-Russia attacks were actually de-escalate, or essentially if we were to see some sort of ceasefire, chip stocks probably would be poised to rally and likely outperform the broader market in our view. So on slide 6 here, the chart here really shows that semiconductor stocks are near their most attractive point in the last 5 years, at least when compared to both the S&P 500 on this chart, the IT sector. Now, interestingly, the combination of share price declines and higher revised earnings estimates have actually made chip companies probably the most attractive relative to S&P 500 multiples and tech multiples here, most in years. Now, most semiconductor companies often viewed, or most semiconductor companies, excluding companies like an NVIDIA and AMD, the Marvells and Powers of the world, have often been viewed as the more kind of value-centric part of the IT sector, and rightfully so, I guess, due to the cyclical nature of the industry. Now, that said, the current discount, again, probably the most egregious we've seen in recent memory. And we actually could argue could be underestimating the long-term potential of this segment of the market. The discount here relative to tech at least could be partly attributable to the multiple expansions seen on the software side led by a Microsoft, as well as some of the revaluation of Apple's multiple over the last couple of years due to their successful shift to services. So it's been a combination of what's gone on in the semi side of things, but also some of the changes that's taking place within the tech sector. On slide 7 here, in this chart, we just show the performance of growth versus semis, versus semi value. And, again, if we kind of look at this recent pullback, growth semis down about 31% peak to trough versus value semis down about 22%. So this was definitely a situation where the growth side of things took the bigger hit because of those planned Fed increases. But in fact, growth companies, in our view, are actually the better bet once kind of some of the industry headwinds start to begin to dissipate, and some of the concerns out in the market also kind of start to alleviate. And longer term, growth is what tends to win out in the semiconductor industry. And when you kind of look at the current inflationary environment and a reset in valuations, we really do think kind of that the setup here for growth semis looks very good heading into the latter half of the year. And actually, when we start thinking about what's driving the growth side of things for semis, it's really data centers and automotive. And when you start thinking about some of the value-centric names, it includes areas like PCs, 5G mobile tailwinds, which are dissipating, and maybe some of the more legacy aspects of automotive. So, definitely the setup, not only over the next 6 months, but the next 3 to 5 years looks very attractive for growth versus value. Now, if we kind of go to slide 8 here, I just want to spend a few minutes here on this slide. And, while we see a slew of risks for the semiconductor industry, we really do our best here to lay out the 8 biggest risks out there. We rank each utilizing a ranking scale of 1 to 10, 10 being of the greatest risk and 1 being the least, with rankings based on our view of most impactful, and in some cases, may be viewed as highly unlikely as taking place. So as you can see, geopolitical risks really dominate the top of the list. First and foremost at the top of the list, our view, the biggest potential risk of the industry would be a future Taiwan attack by China. Whether or not the attacks by Russia and Ukraine increase the risk of a potential move by China into Taiwan, it is creating more discussions about what such an event would do to the semiconductor and the broader economy. It's no doubt that the single biggest risk now for both the US and the semiconductor industry is this. Taiwan, if you think about it, is the most important region of the world in producing the most advanced semiconductors for end products. They control over 50% of the foundry space and over 90% of the chip manufacturing for advanced products. So think about the processors used in iPhones and the manufacturing of NVIDIA's GPUs, for instance. So again, a potential attack by China at Taiwan could really completely turn the supply chain upside down, making these final products like iPhones very difficult, if not impossible, to produce. And while the globe does have other foundries out there, whether it be a Samsung, a Global Foundries, even Intel kind of ramping some of their capacity out there, none of these companies have the ability to manufacture some of the leading edge chips being manufactured by Taiwan Semi today. And this is where kind of, again, maybe some of Intel's plans to quickly expand capacity, some of the Western regions out there, Samsung's intent to triple their foundry capacity by 2026, really do have important implications towards helping to alleviate a potential issue like this in the future. Now, the second risk I'd also highlight, implications and supply constraints from a prolonged Ukraine-Russia tensions out there. We gave this a score of 9. Directly, neither Russia nor Ukraine have an important part of the global semiconductor supply chain, but we do believe events in the region could have broader implications in the space. So chip makers really have been flaunting a more diverse set of suppliers of key materials and gases outside or all across the globe. However, Russia does have control of about half the supply of neon gas needed for the semiconductor industry. And that is really kind of the biggest risk as far as Ukraine and Russia is concerned. So the longer this kind of gets dragged on, or if there are significant damages done at some of these neon gas plants, it could have an issue in terms of getting the actual neon gas needed at some point in the future. But that being said, there are some large stockpiles out there from some of the biggest players. So in the immediate near term, shouldn't be a huge issue. But as we progress through the calendar year and into 2023, it could potentially end up being an issue. Now, the third risk out here that we highlight is China. And China is a risk for the semiconductor industry on so many fronts. In fact, we did publish an extensive thematic report on this one last August. Essentially, we break down the risks in China into 5 subcomponents, and this really the 5 I'd highlight really quick. 1, too much supply chain concentration in China. We should all know that by now, given the pandemic. 2, uncertainty about inventory numbers, demand trends from some key China customers out there. Specifically on the mobile side of things. 3, China has a desire to really create a greater self-sufficiency from U.S. chip makers. They're looking to kind of build out their own local semiconductor industry, but by doing so through an uneven playing field, and clearly the more success they have could pose a bigger threat to some of the U.S. chip makers out there. 4, potential additional exemptions on China customers and vice versa could have negative implications on demand. And then 5, the approval of future semiconductor deals expected again be more scrutinized, and clearly a risk at potentially falling through if we were to see some sizable deal get announced. Now, if you kind of look at the next 4 risks here on the curve or on the table, you can see that they're more cyclically driven and somewhat correlated. So in terms of slower economic growth, Europe-led recession, you've got global GDP growth numbers likely to be revised down, actually have been getting revised down as Russia-Ukraine pose a bigger risk, and higher oil commodity prices also pose a greater risk to areas like Europe. You've got diminishing pricing power also, which we gave a score of 6, as supply eventually starts to catch up with demand. Some of the recent pricing pressure witnessed by some of the chip makers out there will come into question. There's this belief from some, and rightfully so, that semiconductor companies are benefiting abnormally because of a pricing lever due to the tight supply conditions. So as the foundry capacity eventually eases, existing constraints will essentially existing constraints from decelerating growth, costs will start to go down and the pricing advantage will disappear. Now, given that, given the strength of the economy, we're unlikely to see that here in the immediate near term, but it becomes more of a risk as we kind of progress through 2023 and potentially 2024. And then, shortening lead times and a channel rebuild. We give that a score of 5. So long lead times, anywhere from 30 weeks to 50 weeks plus for certain component makers out there, and depleted channel inventories, in many cases below 6 to 8 weeks. We're essentially at historical low levels there. Are viewed as very bullish cases. They provide some better visibility for chip makers and a buffer should end demand abruptly slow. But and also, seasonal strength in the second half should keep some of these trends very favorable. That being said, a combination of greater capacity, slowing growth could be a risk at shortening lead times potentially into 2023. And pockets of the channel potentially will start to see some inventory build, and to some extent we do see it in areas like mobile. And then the final two risks that we highlight here, further inflationary pressures, which we give a 3. Not the hugest risk out there, but definitely a concern in terms of potentially impacting end demand. But as far as the actual supply chain is concerned, most of these chip makers have been able to successfully pass on these higher costs through higher prices. But the Russia-Ukraine attacks have had another unfavorable impact on many of these component prices for chips. So we'll see what happens here in the next couple of quarters. And then finally, you've got the rising interest rate environment. And it has been a headwind on some of the growth names that we highlighted earlier. And it's through the fact that the multiples have compressed, but that's essentially played its role. Even if we were to continue a grind higher in interest rates, kind of the instant higher move has already been made. So we do kind of give it a fairly low score at this point. So as we kind of move here now to slide 9, this is just a chart of just global GDP versus semiconductor sales. So cyclical downturns are always a risk for the industry. And while 2022 is definitely setting up to be another great year, the momentum seen here since early 2020 is likely to eventually face mounting pressures and sets up a more challenging situation as we go into 23 specifically. And history has shown that after several strong up years, which you can see in this chart, sustaining that momentum becomes a more difficult proposition, and some sort of setback, even if it's mild, is expected. So in fact, you can kind of see, we haven't had 4 up years in terms of the semiconductor industry looking back more than 15 years. That said, our base forecast does call for 5% growth here in 2023. So slide 10 here, there you have it. I just kind of want to thank everyone for listening, watching this presentation, and definitely visit our website at advisor.marketscope.com for more information on the thematic tied to this presentation, or for that matter, to get details on any research about the companies within our broader CFRA coverage universe. Thank you.